let's start off with what qualifies as a capital gain.
Well, a capital gain is essentially any financial instrument or real property, other than cash, that you sell at a profit. And then a capital gain, to be beneficial for taxation purposes, would need to be long term. Long term is generally defined as holding the property for greater than 1 year. So if you have Apple stock and you've had Apple stock for 5 years and it's quintupled in value, then if you sell it, you get a preferential tax rate of 20%, possibly 23.8, but typically 20%, as opposed to ordinary rates into the high 30s. So understanding the component of the income in a divorce settlement or tax return is supremely important because, as you can see, it essentially doubles your tax on the sale of those assets. I have had deals, for example, where they're selling property, a home or a stock, where we have delayed it 3 or 4 days for the closing, and that essentially cut the tax rate in half for a capital gain. Other transactions, like in the sale of a company, which could happen many times, particularly in litigation or divorce action. We could package the sale to structure more of the sale as being capital gain, goodwill, the sale of the business, as opposed to equipment or personal service contracts or covenants not to compete. But all of these components of whether it's ordinary income or capital gain has to be planned in advance. And I've had clients that literally we have saved hundreds of millions of dollars, and that's not an exaggeration, on the sale of companies simply by having good planning and structuring it as a capital gain, not ordinary income. Supremely important to understand the components of it, because income is not income. It varies and frankly can be classified with good planning to get radically different results for the same transaction.
And what do family lawyers need to know about the subtle but important difference between short-term capital gains and long-term capital gains, and how that might come about when we're worried that a particular spouse may be playing games with the tax returns as it relates to suppressing income for alimony or child support purposes?
Well, I start with a healthy skepticism, whether it's any litigation, whether it's family law or other civil contractual disputes, to assume that nothing is true that is presented to me. Mr. Reagan many years ago let us know that we should trust, but we should verify. We should confirm everything, not to get into an argumentative to just for the sake of being a butthole. But you should not believe anything that as the opposite side says. You should confirm for yourself holding periods of assets as to the classification of it, and not assume that the opposing side or their CPA is giving you correct information. They're not representing you. They're representing the other side. And the CPA is on the opposite side is an advocate for that attorney and that client, and they are trying to structure the deal to benefit their client, as they should. And you should be aware of that yourself and verify, the nature of the business, the holding periods yourself.
So when you see short-term capital gains on a tax return, how likely is it that that is a result of securities trading, and specifically, day traders versus somebody else who's not terribly active in the market?
Okay. Well, the parts that are day traders, which are all day traders, are also treated as capital gains. And one of the large misnomers that people have is they think that they are, quote, in business as a day trader, and they're clearly not. There's been litigation and tax cases won by the Internal Revenue Service over and over and over again, essentially such that there is no such thing as a day trader who is in business. It is capital gains for him. Now, let me illustrate here. I had a day trader client of mine that proceeded to lose $2 to $3 million when he had a bad year. Now, capital losses are limited, and the ways that capital gains are preferred, capital losses are limited after you've offset against any gains to $3,000 per year. So this client had approximately $2 million of losses, and this was a divorce action that he was purporting to attribute to the spouse because the account was in her name, and telling her that she could take a $2 million loss, and she was a corporate executive, on her return. It just wasn't the case, because day trading is not ordinary losses. It's a capital loss. And in this case, and the opposing side knew exactly what they were doing. Fortunately, I was her CPA, and we caught it, because she would have not been able to deduct that $2 million loss. That was really what he was doing. So again, assume nothing. Verify everything yourself.
All right. One of the things that you and I have talked about quite a bit off camera is, of course, family lawyers struggling with tax basis. So could you give us a quick overview of what you think family lawyers should know at a bare minimum about tax basis and its impact in capital gains?
Sure. Well, first, it helps to understand the terminology. Every profession and every discipline has their own buzzwords that are kind of unique to that business. And when we as tax people, when we use the word basis, it's essentially what is measured when you sell that. Now, basis could be cost. In the simple thing where I buy $1,000 worth of Apple stock, then my basis and my cost is $1,000. That's the typical case, but not always the case. For example, if I buy a $1,000 building, my basis is no longer $1,000 that I bought 10 years ago, because over the years I have depreciated that asset. So now my basis is something less than, in my example, $1,000. And just because it shows a number on the tax return against the basis doesn't mean it's right. I'll illustrate from this morning. I was dealing with a client who had sold a farm in the Delta of Mississippi, and it was a new client, and he had on his tax return that this was $100,000 farm. It's about 1,000 acres of land. Now, those of us who know anything about farming knows that farmland sale is worth a lot more than 1,000 an acre. So I started inquiring. As it turned out, he had inherited this farm from his father about 5 years ago. So yes, the cost was $100,000, but the basis was actually $10 million, because when he inherited this property from his father, he got what's called a step up in basis to market value. And so he was at the process of selling a $10 million farm acreage in the Mississippi Delta. And the other prior CPA was having him pay tax on $9.9 million, $10 million less the 100,000 that just happened to be listed on the tax return as the cost. Cost was the number. That's what Daddy paid for it in 1942. But basis was a totally different number. So basis can be higher, like in the case of an inheritance. It could be lower than cost in the case of depreciable property, and everything in between. So again, have a healthy skepticism, and you as the attorney, if this is not something that you are versed in, please bring in a tax professional to examine the tax returns and make inquiries from it, because like in this case that I'm illustrating with the farmland, and this was going to be a $3 million mistake in taxes, and nothing was nefarious about it. It was just that nobody had done anything except just assume that what's on a piece of paper and it was listed on a tax return as land, that was right. And it was totally incorrect.
Right. So as a follow-up question to this issue, in terms of, let's say we have a nefarious spouse that's showing,
Aren't all spouses nefarious? Isn't that just the very nature of
again, that's a term of art that's in my profession.
it?
So since you don't have a law degree, please don't use that at home
Oh
without
my goodness. Okay.
supervision. But let's assume that we're looking at a tax return and of course, in conjunction with other financial statements, net worth statements, loan applications to banks, blah, blah, blah. And we see large capital gains or large capital losses. In your opinion, as you advise family lawyers, is this more often than not a capital gains issue in terms of what the realized income was, or is it more often a tax basis manipulation?
Well, since almost all of these transactions, when you sell something, the gross proceeds of it, whether it is a security or real property, is typically reported to the Internal Revenue Service by the investment broker or the closing attorney in the case of real property. And so, in almost all cases, exceptions, of course, the gross sales price is probably correct, because that number has been reported to the IRS's big computer in the sky. So I typically don't see that as the problem. But except for just routine security sales, where you have just a trading account with like Bank of America or JP Morgan, they furnish that information to the taxpayer. And that's generally correct. Outside of just those normal equity transactions, and this is a fairly big statement, but it's the case. Uh, I'd say greater than not, what's on the tax return is incorrect. They have made mistakes on it because people are taking, when they're reporting this, it's either because they're trying to be duplicitous or they're just incompetent. The basis that you're measuring gain or loss is incorrect. And I know that's a fairly big statement to say when more than half of them are wrong, but that is the case. And I'll illustrate this. I had a gentleman that works for a publicly traded company. He's an executive officer and he's a client of mine. And it's typical of those types of people. They receive a large part of their compensation through options. And when they exercise those options, typically they will immediately sell the underlying stock. And so there's no gain or loss on the sale. But let me illustrate this of how this could be wrong. And this was the case. This was a large publicly traded company in the Memphis area. Where there was a statement from JP Morgan, who is the transfer agent for the publicly traded company. And there was the sale was for about $5 million, and it showed that there was 500,000 of cost basis on the security and 3.5 million of capital gain. Okay, no problem. He made money. The problem was this: is that when the 500,000 cost was his strike price, that's what he paid for the option. But the difference of 3.5 was correctly included on his W-2 form as compensation. But since corporations tend to be very silo specific on how they run their businesses, the payroll department had never got with JP Morgan and tell them to adjust the basis. And this gentleman, when he came to me, was paying capital gains tax short term of $3.5 million. It's totally incorrect. And this is one of the big four accounting firms that should have known what they were doing. But it was a case where the left hand, payroll, had not talked to the right hand, being the securities dealer, to let them know that there needed to be an adjustment to the basis. And the gentleman, a very talented executive, he knew something wasn't right because he owed $1.5 million in tax, but he didn't know what was wrong. And so I would say though that it was fairly delightful to call the head of this certain firm, tax department, to inform them of their mistake and how there was a new accountant on it. That was I almost would have given that engagement for free. I did not, but almost would have, just to get to make that phone call.
So let's talk a little bit, if you can, and this is putting an apple in the same bucket with an orange or the same basket. So we're not talking about exactly the same concepts by any stretch of the imagination, but I think it would be helpful to family lawyers to hear you discuss um, the relationship between avoiding capital gains when you can, and possibly that being good tax planning that is not nefarious for reporting for your income for divorce.
Sure. So let me speak of this regarding, and there are two different types of capital gains. Generally, one is financial instruments, stocks and bonds, and real estate. Let me speak of real estate here and how something that someone would do in the normal course of business, if they were advised properly, that a family lawyer or any attorney or even a CPA would miss on the return. My clients who are heavily weighted in the real estate industry do not pay tax unless they choose to pay tax. And I know that's a fairly large statement, but with good planning, they really should never pay tax. So let me illustrate this. This was a client that had property in suburban Atlanta. That was the family farm way back in the day, out towards Alpharetta in North Atlanta. And they had sold the property for $10 million. And the basis was $100,000. So it was a large gain. Now, what had been done is that with some good planning, they had bought a replacement property in Florida that was also business investment property. It's called a Section 1031, a like kind exchange. And so, when correctly structured and implemented, we avoided $10 million of gain. Therefore, it wasn't even on the tax return as a taxable gain. Now, if you delve back into the back pages of the tax return, there's a tax form 8824 that would list the like kind exchange, the details of it, and show that there was a $9.5 million gain that was avoided, that was deferred. Now, nobody would have known this if they had not gotten into the bowels of the return. And later, when there was a divorce action for this couple, it was interesting information to know. And it might have not been disclosed by the party about the property in Florida, but a careful examination of the return from several years ago revealed the existence of this property. And so, as a tax strategy, it was perfectly wonderful, but they didn't volunteer this to their spouse.